Jim Bianco is the president at Bianco Research. So, Jim, let's start there, because it seems like kind of the layman's explanation right now would be that if vaccines are on the horizon and already here, we should be in a more hopeful place, according to the 10-year Treasury, than we were before that was the case. So what's going on, Jim? The 10-year hasn't budged since Pfizer Moderna told us they're going to get us out of this mess.
Well, you all forgot another agency in the Federal Reserve is buying $120 billion worth of bonds a month and intentionally sitting on the bond market and trying to squash volatility and trying to squash any type of move in interest rates. And they've largely been successful in it, at least for now, while we hover around 93 basis points in the 10-year note. So they're doing kind of, you're right, without the Fed, rates would probably be on a path higher. We could argue whether or not that's because of real growth or inflation or both, but they should be going higher. But you've got the Fed sitting on them to try and hold them down. And for the time being, the Fed has been successful.
So, Jim, when we hear from Jay Powell this week that they're going to be doing more of the same, basically, not more in terms of dollar amount, but just that they're going to keep doing it. Is there a second derivative conversation to be had here? I mean, the 10-year is overall up since August when he delivered essentially the same message. I mean, I know that it's not the same message. He's tweaked some language, but the mechanics of what they're doing have not changed since August. But overall, yields are higher if we move the goalpost to that period. What does that tell us?
Yeah, you're right. They haven't moved higher. Interest rates moving up by themselves is neither bullish or bearish for risk markets like the stock market. It's more important about why they're moving up. If they're moving up because real growth is expanding and real rates are going up, well, that's actually bullish for stocks. If they're moving up because inflation is expanding and that's pushing us more towards negative real rates, that would be bearish for stocks. And we haven't seen the inflation aspect of that for 25 years. So a lot of people forgot about that. So really, it comes down to the second derivative argument is why are rates going up? I'm in the camp that in 2021, it's going to shift into more of an inflation story. All of the stimulus, the reopening of the economy, the desire, the animal spirits to, get back out there is going to push CPI prices higher in the second half, by the second half of next year. And that could become an issue for the market. It isn't now, but it's on the horizon. So really, the second derivative question is, why are rates going up? I think that the fear is, at least in bond circles, is that it's going to be about inflation, and the near term is being held down by the Fed.
Jim, what's interesting is since that November 10th line in the sand that I'm drawing, the day after the vaccines, real yields have gone substantially lower. We're almost back now down to the lows of the real yield, as we did get a slightly warmer than expected inflation print, and inflation hasn't really, it's picked up a tiny bit, but enough to basically push that real yield down as the 10 years stayed flat. So real yields, Treasury minus inflation, for folks watching, I mean, so there's something building a little bit here. I mean, and is this basically why we've gotten this kind of latest leg and growth and kind of liquidity-driven stocks in the NASDAQ, Jim, because that real yield has gone south again over the past month?
Yeah, I mean, if you look at the Treasury inflation protected securities markets and you look at what's called the inflation break-even rate, that has been moving higher. It's at nearly a 2-year high right now in terms of or at least as the Fed likes to call it, inflation compensation in the market. So as that continues to move higher, there is more and more inflation being, priced in. Now that I've said that, the amount of inflation being priced in is nothing unusual towards what we saw pre-pandemic. It's right back to its old range pre-pandemic from being far below it. So yes, we're pricing in more and more inflation, but we haven't gone to levels that would be noticeable yet. I think ultimately we'll get there probably in the first half of next year, and then it'll become more and more of a story. So the marketplace looks at it and goes, yeah, inflation expectations are up, but they're back to their normal range from being below it. So there's still no problem. So risk markets are enjoying what we're seeing right now and probably will continue to until that point that interest rates and inflation expectations go too far.
Jim, as we've gotten the yield that has since August kind of creeped upwards, even without the Fed changing its tone, even without runaway inflation. I wonder also what the current COVID situation has to do with that, because even though we've got the vaccine on the horizon, investors stopped selling their bonds as soon as the COVID curve started surging again, and deaths went to a record, and hospitalizations and all the terrible stuff that's been going on now for the better part of a month. Do you think that that 10-year can resume its path higher in yield if and when we move out of this current COVID surge, or is it still a very far back seat to the things you're talking about, which are inflation and Fed policy? I mean, is it a coincidence that the 10-year yield stopped moving as COVID picked up again? Should we expect it maybe to keep its path higher if COVID goes down?
Yeah, no, I don't think it is a coincidence at all. You're right. Yesterday, the U.S. unfortunately set a new record for deaths. It set a new record for COVID cases, nearly 250,000 just yesterday alone, 3,500 deaths just yesterday alone. And bond investors are looking at the near term. In the near term, with the rising jobless claims yesterday, with the economists continuing to downgrade the economy near term, and more whispers about a potential negative payroll print for December released on January 8th, they're going to think about pausing their idea about inflation becoming an issue. Stock investors will continue to live in the second half of 21, an era where we've got mass vaccination, we've maybe achieved herd immunity, mass reopening. Maybe you and I could go back to Wrigley Field in the second half of 21 as well, too. And they're going to live there, and they're going to be happy with that. The question is, you're right, what happens once this wave peaks? And hopefully it's a couple of weeks, no more than a month away from peaking, and it isn't going to drag on and on. Then bond investors are going to turn their attention to reopening and the potential of inflation, or at least real growth. And I think you'll see interest rates resume their path higher then at that point.
Hey, Jim, one question here. I like the talk, by the way, about Wrigley Field. I'm in for it. Though I'm more of a White Sox guy, Jim, but we'll get into that when the time is appropriate. Too. Okay, doesn't have quite the same ring, guaranteed rate field. That's all right though. They got better food. Hey, Jim, let's talk about balance sheet real quick. A pretty sizable tick up this week now to the highest levels of the year. But if the Fed's not increasing the rate at which they're buying, how come that's happening? Is there stuff going on outside of what they've told us in the bond buying program?
No, usually at the end of the year, there's a lot of technical adjustments that the Fed has to do. They own a lot of bonds that are going to mature on December 31st or December 15th as well, and they try to maintain a constant level on their balance sheet. But they also know that they can't step into the market on the 30th or the 31st of December and buy a massive amount of bonds, because they've got a bunch of bonds that are going to mature on December 31st. So they're doing it now while there's still a little bit of liquidity. So yeah, you do see a little bit of jumping around in the last couple of weeks of the year, maybe the first week of the year. And I think it's more under the guise of technical adjustments than something bigger going on.
Okay. Jim, good to catch up. Thanks for joining us here this morning. Have a great weekend. Jim Bianco is president at Bianco Research.